directional movement index is an indicator that was developed by Welswilder in 1978 for commodities that helps reveal whether an instrument is trending. It does so by identifying which direction the price of an asset is moving. The DMI can signal both the strength and the direction of a trend, as well as providing clues on buying and selling pressures. The indicator consists of 3 lines: a positive directional movement line, DI+, a negative directional movement line, DI-, and together they help a trader to gauge the direction of a trend. The third component is called the average directional index, or ADX, which helps investors get a sense of the strength of the trend. The key levels to watch on the ADX are 20 and 25. If the ADX is below 20, it's likely that there's a weak trend in the market. Prices might be trading sideways or consolidating. Meanwhile, if the ADX is above 25, this suggests there's a strong trend in the market. That's when you should start looking for crossover signals from the DI+ and the DI-. If the DI+ crosses above the DI- with the ADX above 25 and rising, that's seen as a potential buy signal. If the DI+ crosses below the DI- with the ADX above 25 and rising, that is seen as a potential sell signal. So in summary, buy and sell signals from DI crossovers should only be considered when the ADX is above 25 and rising, because that tells us when the market is trending. Any ADX reading below 20 tells us that this is not a trending market and DI crossovers should not be considered. So where should you put your stop? Well, with this indicator, there's a concept called the extreme price rule. This says that at the time of the DI+ and the DI- crossover, the extreme price on that day, either the high or the low, becomes your stop loss.